Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
When should you first start saving for retirement? It's your first paycheck, of course, but who does that? No one, because retirement is 200 years from now. Then you hit your 30s, right? Then you start your family, and then you have a couple of kids, you buy the house. Then you hit your 40s. Guess what? You get a bigger house, a nicer car, and then the kids are off to school. Then you hit your 50s. Guess what? The kids are back from school on your payroll again. Then you hit your 60s, and guess what? You have saved nothing. That is the cycle. That is very, very common. Don't let that happen to you. Welcome to the program, because what we're going to talk about today is strategies that you can implement in every section of your life. If you're 30, if you're 40, if you're 50 and 60, there are some things that you need to know to figure it out. My name is Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I'm with the big man, as always, Big Al Clopine. He's sitting right over there. So when we dive into this, you have to take a look. Don't be a statistic. If you are 30, start right now. If you're 60, start right now. That's what's on my mind today. So let's take a look at some statistics here. Here's the problem, is that we go through these cycles of life and everything happens but saving for retirement. 57% of workers have less than $25,000 saved for retirement. 23% of workers over the age of 45 have $25,000 or more. But look at this, 14% think that they can afford long-term care costs. This is an issue. This is a problem because it's a lack of planning. Don't let this happen to you. Start right now. Let's bring on the big man, Big Al Clopine, to kind of dive in a little bit deeper. Alan, are you 30?
Yes.
Are you 40?
Correct.
Are you 50?
Yes.
So let's take a look at some strategies and some ideas that people need to take a look at. And the earlier, the better, of course. But there's a lot of people in their 50s and 60s that haven't saved, and it's never too late.
Well, that's exactly right, Joe. And so this will be a great show. Depending upon what age you're at, there's different things that you're going to want to concentrate on. And I would break it down this way. There's things that you want to do in your 30s, your 40s, your 50s, and 60s. And so let's start with the 30s. This is when you want to make sure you get started. Maybe even in the 20s. Some of you actually do save in your 20s, but a lot of you don't. But by your 30s, make sure that you get started in saving. And then your 40s come around, and it's all about, you know what, we got a little sidetracked here with the family or new home or whatever. Let's get back on track. Then we want to get into our 50s, and which very often is our highest earning years. Let's make sure that we accelerate our retirement savings at that point. And then in our 60s, let's start preparing for retirement. There's a bunch of things that you want to do there. And Joe, when you think about retirement, it's all about knowing what to do at each stage. And if you can just do some of these things that you're supposed to do, your retirement's going to be a lot better.
Right, yeah, it's easier said than done.
I know.
It's pretty simple to implement, but it's simple to say, but very difficult to implement. Because the earlier the start, Al, the better off you're going to be. So if you just take a look at the compound interest, just accumulation over a long period of time, you can add up a lot of money.
Yeah, when you look at a 30-year-old, let's say it's going to work till age 65 and just saves $10,000 a year over that period of time, 7% rate of return, you end up with $1.4 million. Now, if you start this same exercise at 40, it's $630,000. If you start it at 50, it's only $250,000. So it behooves you to start as early as you can, because that way the compound of money is going to work the best for you. And Joe, it really gets back to the 30-year-olds. That's when you got to get started, and there's just a few things that you want to do.
Right. I mean, if you start at 30, right, the amount of money that you need to save is significantly less if you start at 50. If you just look at those stats, if you just waited 10 years, right, a 30-year-old and a 40-year-old, they almost have half of the amount of money accumulated with the same amount of the same dollar invested on an annual basis. So let's get into some steps that a 30-year-old should be taking. If you're watching this program, max out your 401k as much as you can, or at least to the match. If you have a match in your 401k, contribute to that 401k plan, to that match. That is free money. That's 100% rate of return. Then you want to take a look at contributing to a Roth IRA. So here's the steps of saving. Max out the 401k, then go to the Roth, and then look at, of course, eliminating high-cost debt. Because when you look at student loans, or if you look at credit card debt, car loans, things like that, that can add up significantly. And then you're just bogged down, right? Then you're chasing trying to pay off this debt versus paying yourself first.
Yeah, and when it comes to credit card debt, in some cases it's low interest rates. Maybe you get a balance transfer, and you're paying really nothing, and then all of a sudden you notice it gets up to 11%. You miss a payment, and you look at that, it's already 29%, and you never get ahead of it. So you want to get that high interest paid off. Car loans are not too bad right now for a lot of people, but still, you don't want to be burdened by all these big payments. Student loans are another one. You got to get this debt paid off. And then some other things that you want to do, when you get into your 30s.
Yeah, you got to create that emergency fund for sure.
Yeah.
You want to make sure that you have enough cash just in case of emergency or an opportunity comes around. You got to keep expenses under control. I know when you first start getting your paycheck, you want to spend, but you have to take a look at paying yourself first, keeping those expenses under control, and then if you do get a bonus or if you get a raise, try to save half of that. The other half, have fun. Do whatever you want with the money, but try to save half of that raise, half of that bonus. Because if you start early, as the numbers show, if you get a 5, 6, 7% rate of return over the next 30 years, you're going to have a significantly more comfortable retirement. But I understand that, hey, when I'm 20 and 30 years old, retirement is so far off, there's always tomorrow. But if you can just start right now, saving a couple of extra bucks, because ask your parents, ask your grandparents, everyone will tell you this. Hey, if you would have started saving, when would you first start saving? They would say, well, my first paycheck, I would have started saving then. Most people don't do it. This is a great opportunity for the younger generation to take control of their finances and start saving, Al.
Yeah, absolutely. And as you say, Joe, and in a lot of cases, it's like, well, I can't really save that much. Right? I'm spending every penny. And the thing is, try to figure out cutting out maybe one thing or two things. And so then you got a little bit of money going to the 401k. Joe, as you say, you want to make sure that you get up to that employer match, because that means you put a certain amount in and the employer matches that. So it's like free money. So you want to make sure that you do that. And as you just saw, the compounding of money makes such a big difference. And so many people end up in their 40s and 50s really without saving that much, Joe.
Well, speaking of 40s and 50s, let's dive into that. We got to take a short break, but when we get back, we're going to introduce Mr. Michael Benier. He's a certified financial planner at Pure Financial Advisors. He's going to break some things down of what you got to do when you're in your 40s. I'll break things down when you get in your 50s. Big Al and I will tackle you for those of you that are in your 60s, so you don't want to go anywhere. You don't want to miss a second. The show's called Your Money, Your Wealth. We'll be back in just a second.
Hi, I'm Matt Balderston, Certified Financial Planner with Pure Financial Advisors. Did you know, according to U.S. News, when switching jobs, there are 3 ways that you can avoid paying taxes or early withdrawal penalties from your 401k. First, you can leave it in your old 401k. Second, you can roll it over to an IRA. Or third, you can transfer the balance into the 401k at your new employer.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine, hanging out, talking finance, things that you should consider when you are looking at retiring. We got Mike Benier coming up this segment, so don't go anywhere. Before we get to him, let's go to the true false.
I'm in my 30s, so it's better for me to save for retirement by putting money into a Roth IRA rather than a 401k, since I plan to have a higher salary in my 40s and 50s. What do you think, Joe?
That's true and false.
True and? Oh, wow. Okay.
Because we just went through the order, right? So if you're looking at saving some money, you can't max out all plans, is that you start with the 401k first if they have a match. So go to the 401k first. Take advantage of that match. That is free money. That's 100% guaranteed rate of return on your dollar. Then after the match, then that's when you go to the Roth IRA. Then if you have more money after that, after you max out the Roth IRA, go back to the 401k. If there is no match and you are in a low tax bracket, then yes, very much so. It would be true to take advantage of the Roth IRA. But it's a little bit more complex. You just have to take a look at the plans and the rules and everything else.
Yeah, so that's one of those cases where it actually is true or false, depending upon the situation. So, Joe, I'm actually real excited because we're going to introduce here momentarily one of our senior financial planners at Pure Financial Advisors, Mike Benier, with over 10 years experience. In fact, I think it's about 12 years experience to be exact. But at any rate, I want to get into what the 40-year-olds should be doing. And Mike, first of all, welcome to the show.
Well, thanks, Al. Thanks for having me.
Yeah, great to have you. So let's first talk about, we talked about 30-year-olds, and we know we need to get started in our 30s, but why do so many 30-year-olds kind of get off track?
Well, I think it's a few different things that you guys have touched on. You know, a lot of changes happen. You have a family, you save for a house, you buy, a more expensive car because maybe you're earning a little more. You start raising kids. Anyone that has kids know that, children can be and are expensive. So a lot of money is going towards that, and they don't necessarily focus on retirement.
Yeah, and so family, and we want to have families, we want to get married,
Sure.
we want to have kids, we want to have a nice home, so all these things kind of get in the way of our savings. So we wake up, we're in our 40s, we haven't saved that much, we got to get back on track. So what's the first thing that 40-year-olds should be doing?
I think the first thing is setting a goal, right? Establishing a savings goal, whatever it might be. Maybe it's 15% of my income, 20% of my income. Depending on where you start, maybe you start at a certain point, and then every month or every quarter or every year, you plan on increasing it at a certain increment. Maybe next year I'll save an additional 5%. But you have to set those goals, otherwise there's going to be no way to actually achieve the goal, right?
Yeah, well, I think that's well said, because in a lot of people it's like, well, wait a minute, I can't really save that much more, but at least start with something, right?
Right.
Even if it's 1 or 2 or 3% of your pay. And then each year as you get raises, bonuses, whatever, add a little bit more to where you get up to saving 10, 15, even 20%, and then you're going to be in a much better position.
Exactly.
Yeah.
And what I like is go higher than you think you can actually do. Right? Because it takes effort to then change it and adjust it down. I think if you set it high and it's automatic, especially if you're saving in your 401k, that'll be out of sight, out of mind. You'll end up saving a lot more than you think you actually can.
I mean, it's all about saving money, because that's what's going to help you in retirement.
Right.
So, okay, so set a saving goal, right?
Yeah.
And then where should you save?
Well, I think you want to definitely, like Joe had said, max out or contribute towards the 401k to at least get the match, potentially contribute to a Roth IRA, and then look at saving outside of retirement accounts. Those can be pretty tax-efficient pools of money as well. Just saving into a non-retirement brokerage account might give you a lot more flexibility or control over your taxes in the future. So it's just planning ahead and deciding, how much should I save, and where should I be saving it, depending on your individual circumstance.
Yeah, and of course part of this is what tax bracket you're in.
Exactly.
So if you're younger and you're in a lower tax bracket, you might want to get more money into a Roth IRA or maybe a Roth provision of a 401k.
Sure.
Because the tax deduction is not as important for you, and that money grows tax-free.
Exactly, and especially if you're in your 30s or 40s, you've got a lot of time for tax-free growth, if that makes sense.
Right. Okay, what else should 40-year-olds be focusing on?
I would say there's three, other key things. Make sure to pay yourself first. Don't do what most people do. They focus on, let me get the children through school. Right, okay, now we've got kids in our 30s. Now I'm in my 40s, maybe now they'll go to school. Let me get that wrapped up, then I'll start saving for retirement. You really want to focus on saving for retirement as early as possible, because children can get loans, they can get scholarships, but unfortunately there's no loans or scholarships for retirement.
Right.
The next thing is making sure to choose the appropriate investments. Sometimes people are taking too little risk, especially if you're in your 40s. You've still got a good amount of time on your side. You need growth, especially when interest rates are as low as they are right now. You do need to take some risk. And then monitoring, right? Making sure to monitor the progress and see where you're at. If you set something up in your early 40s, then as you get to your late 40s, you need to change the plan, change how much you're saving, where you're saving it. So you just need to continue to assess where you're at.
Yeah, no question. I think those are good things. And where can people go for more information?
Yeah, if you want more information, or if you want to sit down with a certified financial planner with Pure Financial, you can visit our website at purefinancial.com. That's P-U-R-E, financial.com. And we'd be happy to give anyone a free assessment, see where they're at, and help them achieve their goals.
Great. Well, that's a great offer. Now, let me now switch gears a little bit, Joe. I'm going to turn it back over to you, because now in your 40s, you get back on track. What about your 50s? What do we need to be doing in our 50s?
You got a lot to do in your 50s, Al.
I know,
There's a
and
ton.
I'm in my 50s. So help me out. Tell me what to do.
Right? Let's get down to business. So let's figure it out here. Because here's the problem: is that when you look at people in their 50s, a lot of you haven't saved. But then you get this hopelessness feeling, right? It's like, oh my gosh, I'm 50, I'm 60, I don't have anything saved. Retirement is going to be forever from now. I'm just gonna work forever. Here's a recent statistic: is that 50% of you are going to get forced into retirement early, even though you want to work as late as you can. Now's the time to start. Let me walk something through. If you're 50 or 55, all right? So a couple of things that you want to do. First of all, you want to cut spending as much as you can. I know it's hard, but you have to try. Cut your spending. Look at maximizing your 401k plan. If you can maximize this plan, if you're 50 or 55, there's a lot of things that you can continue to do. It's easier for me to say. Then, if you get that match in your 401k plan, Look at this. So instead of retiring at 65, you push it out to age 67. So let's say I'm 50, I want to contribute to the 401k plan. I get a match in that 401k plan. I invest those monies. I get a 7% hypothetical rate of return. Now look at this, $865,000. That's a huge sum of money that you can have a very comfortable retirement with. If you're 50 years old or you're 55, here's the steps. You want to start right now. You want to look at, okay, can I cut some spending? Then from there, you can save more. Manage the assets appropriately. Now, if you do not have a 401k plan, a lot of you don't, try to save into an IRA or a Roth IRA. If after you fund those, look at non-qualified investments or just mutual funds or stocks or bonds outside of retirement accounts. Save, save, save. That's the key. Now, let's walk it down. There's really 4 steps that you want to take a look at here. Number 1, maximize your retirement plans. If you have them, they're so key. You get a tax deduction, a gross tax deferred. Then cut expenses. You have to take a look at what you're spending. Make sure that you can cut expenses so you can maximize these retirement accounts. Then you want to look at creating this financial plan. Most people do not have any strategy. So if I'm taking a trip from right here, San Diego, to New York, if I do not have a roadmap, it's going to take me forever to get to my destination. If you have a roadmap, if you have a clear, concise financial plan, knowing how much money that you should save, when should you take your Social Security benefits? Do you have pension? How much risk should you take? What is the tax consequence? There's so many things that you have to take a look at. That's creating this financial plan. And then finally, you want to create or update your estate plan. God forbid, 2 things are certain in life, taxes and death. When you die, right, you want to make sure that all of your stuff, all of your belongings go to where you want it to go. Those are the steps that you want to take. Please do this. All right, we got to take a break. When we get back, for those of you that are in your 60s, I know you've been waiting this whole show. When are they going to talk about us? When are they going to talk about us? Well, right after the break, we're going to talk about what you should do in your 60s. So don't go anywhere. Show's called Your Money and It's Your Wealth. Hey, welcome back. Joe Anderson here, alongside Alan Clopine. Your Money, Your Wealth is the television show you're watching, and we're talking about getting things together for your overall retirement. If you're 30, 40, 50, or 60. Before we dive into the 60-year-olds, let's go to the true-false question to see how you did here. Al?
If I want to retire at 65, I should switch to low-risk investments in my 40s so I do not put my nest egg at risk. And the answer to that, I'll take it first, Joe. The answer is no, absolutely not. You're probably not going to retire for 20, 25, even 30 years. You've got plenty of time to be a little bit more aggressive. I'm not talking about being crazy aggressive, but make sure you have different classes of stock, large company stocks, small company stocks, some international. Make sure you stay invested. You'll be able to ride out different cycles. As you get closer to retirement, then maybe you want to get a little bit more conservative, but maybe that's only a few years away from retirement.
Yeah, that's probably the easiest true-false question I think we've ever had in this television program.
You're probably right.
So if I'm 20, should I take more risk or less risk?
Yeah, but you know what though? The 20-year-olds are taking very little risk because they don't understand the market. So.
Right. No, that's very real because what they've experienced was the Great Recession and then the dot-com bust, and so they don't have trust in the overall market. So the younger generation are not taking the appropriate amount of risk in their overall portfolio. So I just take everything back. So let's talk about, instead of in your 20s or 30s or 40s, what should you do if you're in your 60s? Okay, so now retirement is knocking on the door. One of the things that you absolutely need to figure out here is, what is the retirement date? It's not this arbitrary number. It's like, I want to retire at 62 or 65. You want to make sure that you have enough capital to maintain a lifestyle long term. Al, Social Security claiming strategies is a big thing too.
Well, it is, and believe it or not, there's over 500 different ways to collect Social Security if you're married. In other words, you can collect in different months. One spouse can collect, the other spouse can collect at different times. There's the spousal benefit, and you want to make sure you understand how this works, because if you screw this up, there's no redos. You kind of have the same income for life. And in many cases, Joe, I would say this. For people that can afford to wait on your Social Security. You can wait as long as age 70. You'll get the maximum amount possible in Social Security, and that lasts the rest of your life, and it's indexed for inflation.
Right. There's a break even, of course, because if I take it at 62, 66, or 70, right, I would receive more income earlier than if I wait till age 70. A couple of other things that you want to make sure that you consider is healthcare cost. Right, healthcare costs are on the rise, and then making sure that you're having fun in your overall retirement, because a lot of you approach retirement, you end up in retirement, and then it's like, now what? Make sure that you plan it out, what activities that you want to do, what your social circles are going to be. Let's flip it over to you now. Let's get to your email questions, and so let's make sure that we can get these right, Al. What do you got?
All right, I've got some good ones today, but I will say, first of all, what's your retirement plan, Joe? Ice fishing? Is that?
That is it. I'm going to move back to Minnesota. I'm going to sit on a lake in the middle of winter and freeze.
That's what I thought. That's what I thought. Okay, so let's get to email. So here's one of your email questions. So this is from Elizabeth, Carmel Valley. So if I file my taxes separately from my husband, can I contribute to a Roth IRA? Since I make $110,000 a year, my husband earns $150,000 a year. So we're talking about a Roth contribution. So that's $5,500 a year or $6,500 a year if you're 50 and older. Can you make a contribution if you're married filing separate? The answer is no, not with that kind of income. In fact, your income has to be below $10,000 to make a Roth contribution. So it's very difficult when you're filing separate to actually be able to make those contributions.
Yeah, that $10,000 threshold is for filers that file separately. So Al, you've been a CPA for quite some time. Tell me, when does it make sense for someone to file separately?
Well, it's a good question, and I get this all the time. And typically, there's almost no situation where it's better to file separately in California, because in California, we're a community property state, which means that half of my income is my spouse's and half of her income is my income. So we end up with two equal returns, and the tax rates are higher. So generally, it doesn't make any sense unless you come into the marriage with a lot of separate assets producing a lot of separate income. That would be about the only time in California. But Joe, why don't we get to the next email question here, because I know we just have a couple minutes here. This is from Mark in Alpine. He says, I'm in my 40s, I'm in good health. Do I need disability insurance at this age, or can I wait till I'm older? Well, that's a good question. I think it depends upon who, on your income. It depends upon if you're married and what your spouse is making. I would say it this way, Mark, is if a loss of your income is going to make a big difference in your lifestyle, then yeah, you probably want disability insurance, because it's for you, it's for your family, for your spouse, for your kids, and so forth.
Well, I mean, if you take a look at it like this, Al, so someone in their 40s, right, the biggest asset that individual probably owns is their ability to earn an income. So if I'm 40 years old making $50,000, $80,000, $100,000 per year, you got to take a look and extrapolate that over the next 25 some odd years. And so if you get disabled, you want to make sure that you have income coming in. The first place to look is your employer. See if they have a long-term disability program. Now, also from a taxability standpoint, you want to pay those premiums through your employer. So then when you do receive those premiums, those would be tax-free to you. If you were ever to become disabled, that benefit would be tax-free. If your employer pays that premium, just know that the benefit that you would receive would be fully taxable to you. 1 minute, Al. Let's see what we got. Okay,
I think we got one more question from Steve in Leucadia. He says, I'm in my 30s, and the only money I've saved is in my Roth IRA. He's saying, since I've already paid taxes on the money, can I use it as a down payment on my house? And Steve, the answer is it depends. If it was a Roth contribution, you can pull out that principal amount tax-free, no tax, no penalty. But the growth itself, you actually can't pull that out until 59.5. And if you do pull the growth out, then you have to pay taxes on that plus penalties. If it's a Roth contribution, it's a little different rule. You got to wait 5 years before your principal, the original conversion, would be available for a home down payment.
But unless it's a first-time home buyer. So if you're a first-time home buyer, there are special rules within the IRS legislation that allows you to take money out, right, without the penalty. Okay, so you just want to take a look at if it's a first-time home buyer, you will be able to take some of those dollars out of your retirement account. Understand that you will pay the tax. If it is in your IRA, your Roth IRA, you will avoid the 10% penalty. But that's the last place you want to take is your Roth IRA when you're that age. You want to let that money compound tax-free. All right, we got to get out of here. If you have an individual retirement account, an IRA, stick around next week, because there's a lot of mishaps that will take half of that IRA if you don't do this correctly. I want to thank Mike Benier for joining us today. Big Al Clopine, wonderful job. My name is Joe Anderson. Have a wonderful, wonderful weekend. You just watched another episode of Your money, your wealth. Have a great weekend.
Ready to start building the retirement you always dreamed of? Meet with one of Pure Financial Advisors' certified financial planners for a free assessment by calling right now. 1-888-99-GOALS. That's 1-888-99-GOALS. Or go to our website at purefinancial.com. Your retirement is within reach. We'll show you how.